So these are about earnings per share. So we are doing a question of December 2013. So December 2013. So earnings per share. So we always say that in earnings per share, you have to compute both basic earnings per share and you have to compute for the diluted earnings per share. So for this question of 2013, that is what they were asking, of which we know that basic earnings per share, you always take the profit attributable to ordinary shareholders, you divide with the weighted average number of ordinary shares. That is how you get the basic earnings per share. So of which to get the profit attributable to ordinary shareholders, you always take the reported profit after tax, you raise the profit attributable to non-controlling interest, you raise the preference, dividends. So for the profit after tax, so remember that is how you are supposed to get the PAUs, that is the profit attributable to ordinary shareholders. I have said you start from the reported profit after tax. So the reported profit after tax you are already given in note 1, 85.6. Then you raise the profit attributable to the non-controlling interest. So there was none. There was no profit attributable to the non-controlling interest. Then you raise the profit, not the profit, but you raise the preference dividends. So the preference dividends was here because we said the total value. So you are given the 2 million, 10% cumulative preference shares, 20 million. So in order to get the preference dividends out of these 20, you always take the contractual rate of 10%, you multiply with 20. That is how you get the preference dividends. And that is what you subtract from 85.6 to get the house. That is the profit attributable to ordinary shareholders. So that is how you get the first thing here. So the basic earnings per share is equal to powers of our note. So of which powers, which is the profit attributable to ordinary shareholders, you start with the profit after tax, which is given in note 1. Then you raise the preference dividend. So I have shown you on how to do this. Then you raise the profit attributable to non-controlling interest, but there was no profit attributable to that non-controlling interest. Then I said next, the thing you have to look for is the one knows the weighted average number of ordinary shares. Weighted average number of ordinary shares. So remember that the weighted average number of ordinary shares is all about you weigh the number of shares, that is ordinary shares to be more specific, as per the time factor. So, but now with more emphasis, you have to take into place is all about in that year when you are doing that one else, the weighted average number of ordinary shares. Was there a bonus issue? Was there a right issue, share split, or reverse split? But mostly what you have to check, even if yes, all of them they might have an impact, but the one which has a bigger impact is all about the right issue. So if there's a right issue, remember that we have to use the relevant formula to get the one notes. And in this question, there was a right issue. And you know what is a right issue? That is not something I have to explain again. But I can be forced to explain again because we always say that the right issue is whereby the company issues shares to the existing shareholders at a lower price than the existing market price. So in note 3, there was a right issue. They say that on 31st August 2012, the company made a right issue of 1 ordinary share for every 4 ordinary shares held on that date. The exercise price was 36 per share, and the come right price on the last quotation was shilling 48 per share. So which means that when I would be doing my one nose, weighted average number of ordinary shares for this year, I have to take into place how to compute when there's a right issue, how to compute this one nose when there's an element of this right issue. So which I say that in order to do that, you have to use this formula. So I told you first to write the formula. So formula, when there's an element of right issue, this is how you do it. We always say that ordinary shares before right issue, you multiply with fair value before right issue, you divide with the theoretical exercise price, you multiply with the period before right issue, you add the ordinary shares after right issue, you multiply with the period after the right issue. So this is when there is an element of right issue. That is when you use this formula to get the one knows. So before now we apply the formula. remember that you need to get the elements, the items which must be applied in the formula, which means that you need to get the ordinary shares before right issue. You need to determine the fair value. Theoretical exercise price, you have to determine. Period before right issue. Ordinary. So all of these items in the relevant formula, you have to determine them. So that is why you can see that I started with the analysis of the shares. So these are about determining the shares to be applied in the formula. So this is what you do first. So these are about analysis of shares. So here I'm doing the analysis of shares to be applied in the formula. So this is just analysis of shares. So it's not the one notes. So these are about analysis of the shares to be applied in the formula. So I'm doing the analysis.
Yes.
So we started by writing the date, details, and shares.
Yeah.
So date, detailed, shares. So our financial year, remember that it was ending in which period? 31st
2013.
31st March 2013,
13.
which means that it starts when?
1st April 2012.
So if your financial year is ending 31st March 2013, obvious, it would be starting on 1st April
April
2012. 2012, eh?
Yes.
So that is 1st April 2012. So that is why you can see I'm starting with the analysis as at 1st February around April 2012. Eh? So the first thing there is 1st April 2012. So that was the balance breakdown. That is the start of the year. So as at that period, our shares were, you can see 6 million. Eh?
Yes.
This one, because now this capital structure you are given up there is as at that 1st March 2012. So that 1st March 2012, which is the closing of the previous year. So you know that after that 1st March, so you move to 1st April.
Yes.
Yes, which means that by the start of the year, there was that 6 million ordinary shares. Remember, here we deal with the number of shares, not the value, not the total value, but the number of shares. So that's why I'm writing the 6 million ordinary shares. Because per share was 5. That is why we are arriving at 30 million. But we deal with the number of ordinary shares. That is why we call it weighted average number of ordinary shares. We weigh the number of ordinary shares. Then after that, there is another ordinary shares in note 2. Because note 1 is just profit after tax. Note 2 was on 1st May 2012, the company issued 1.5 ordinary shares at full market price. So 1st May 2012, that is what you write next. That is a new issue. So the date is 1st May 2012, they made a new issue. So let me show you how to do it. So this is what you write. So 1st May 2012, so it was a new issue, the 1.5. So for the date, 1st May 2012, or details, new issue, shares is 1.5. Then after that, we move to additional information number 3. So additional information number 3 is where there was a right issue, of which obvious, through that right issue, they issued shares. So the proportion was, the proportion at which they made a right issue. 1 ordinary share for every 4. It was 1 for 4 held on that date. The exercise price was 36 per share, and the come right price on the last quotation was 48 per share. So which means that in order to get the ordinary shares through that right issue, so you take 1 for every 4. It was 1 for every 4. That is 1 for every 4. So for the analysis of these shares which were again carrying out, so remember that already we have done the first one. Or with the first one, I've said that you just write the date, details, and the shares. So which I said by the start of the year, 1st April 2012, that is the start of the year, there was this 6 million, that is direct. I've shown that. Then we move to the next additional information to check where there was ordinary shares. So I've said note 1, there was profit after tax. That one is not the ordinary share. So we have to check note 2. Note 2, there was on 1st May 2012, the company issued 1.5 million ordinary shares at full market price. So 1st May 2012, the company issued 1.5 ordinary shares at full market price. So which means that they were issued at a full market price of shillings 5. So
Yes.
initially, by the start of the year, the ordinary shares, remember that were being issued at 5. That is the full market price. The 5.
Yes.
This 5, that is the price at which the shares were trading. So on 1st May 2012, the company issued 1.5 ordinary shares at full market price, which is okay. So we are just supposed to take the 1.5 as our new issue, which occurred 1st May 2012. So I said you will just write, and the date is 1st May 2012, which is a new issue of 1.5. The shares is 1.5. So we are done with that. Then after that, we move to the next additional information. We check again where we have ordinary shares. So where we have ordinary shares is this note 3. So note 3, they say on 31st August 2012, the company made a right issue of 1 ordinary share for every 4 ordinary shares held on that date. The exercise price was 26 per share, and the camp-right price on the last quotation was 48 per share. So which means that this implies this. So on that 1st August 2012, so they made a right issue. So obviously the right issue is all about the ordinary shares with the issue. So 1 ordinary shares for every 4 held. So for every 4 shares, that is ordinary shares which were held, there was 1 share which they were receiving.
Yes.
So in order to get the ordinary shares with the issued on this date, which date is this? 31st August 2012. So you have to take 1 for 4 times the shares which were held by that time. How many shares were held by that time? Because the proportion is 1 for every 4. So how many shares were,
7.5.
which is?
7.5.
It's 7.5 because as at the start of the year there was 6, and by May there was this 1.5.
Yes.
So that is why I'm getting the total of 7.5. That is where you are getting the 7.5. So it's the same as taking 7.5 times 1 over 4. So it's like saying 1 for every 4 times 7.5 to get the ordinary shares which were issued through the right issue. The ordinary shares which were issued through the right issue. So that is fine. So and that is what we get here. Also already that one has already been captured for you. So that is what I did there. So 1 for every 4 times 1.5. So you see the date is 31st August 2012. The right issue, it was a right issue. 1 for every 4 times 7.5.
Yes.
All right, so we have to check another thing. So after we are done with the recording of the shares which were made through the right issue, let us again check if there was another shares before we apply in the formula. Remember that we are checking the shares, to be more specific, ordinary shares which were issued in that period, in that financial year, so that we can apply in this formula. So we are already done up to note 3. So let us continue with note 4. Let us continue with the note 4. So note 4, they say that on 1st January 2013, holders of 10 million, 12% convertible bonds exercise their conversion right. So each 10,000 of the bond is convertible into 250 ordinary shares of shillings 5 each. So you can see that, yes, this is a convertible bond. So when I would be coming to diluted earnings per share, I would be telling you that we use potential securities to do diluted earnings per share. And these potential securities are the securities which are convertible to ordinary shares. So under diluted earnings per share, I will tell you that you are supposed to use the securities which are likely or unlikely to be converted to ordinary shares. So which are likely or unlikely to be converted to ordinary shares. But under basic, and that is what we are doing, you just use the securities which are converted to ordinary shares. So like now in this scenario, that is why I'm just trying to explain it. In note 4, there was this security of 10,000. So out of that 10,000, 10 million was converted. It was not 10,000, but that was a proportion. The security was up, yeah, the security was by 25. So the 10,000 was a proportion. So the total value of the security was this 25. The 12% convertible bond, this 25. So I said that when I would be moving to diluted, I will be telling you that the security which you use are the potential securities, the one which is likely or unlikely to be converted to ordinary shares. But now, in order to capture this security in the basic earnings per share, which value was converted, we use the one which are converted now to ordinary shares. So out of the 25, which one was converted to ordinary shares? That is what I imply. So that is why they said that note 4, on 1st January 2013, holders of shillings 10 million, 12% convertible bonds exercise their conversion, right? So which means that out of the 25, 10 converted. In which proportion? Each 10,000 of the bond is converted into 250 ordinary shares of shillings 5. So 10,000 of the bond. So for every 10,000 of the bond, it's converted to 250. So, and we can see that 10 million of the security was converted. So we deal with the one which is converted. That is according to basic earnings per share. But for the diluted, I will deal with the total security because I've said the one which is likely or unlikely to be converted. Even if they converted 10, I will deal with that when I will be doing diluted, and I will deal with the 15, which was never converted, but it is likely to be converted or unlikely to be converted. So which I will take 10 times 250, 10 times 250 divided by 10,000. So that is the model they were using. So I have to reduce the 10 million to 10 because it was just in terms of millions. It was in terms of millions because the 25, you can see even up there, it was in terms of millions. So you take 10 times 250 times 10,000. You are getting what? What are you getting? 10 times 250 divided by 10,000.
0.25.
0.25. That is fine. So that is what they arrived at here. So remember that this conversion occurred 1st January 2013. That is according to note 4. That is what we are told. That is according to note 4. So they say that on 1st January 2013, so that is the date. Then details, you say conversion of bond. What have we already explained? So that is how you get 0.25. So that is the analysis we have done. That is just the analysis we have done. Because the rest additional information is just the share options, and that one is never applicable in basic earnings per share. Note 5, they say that on 1st January 2013, the employees of the company were granted share options to purchase 1 million ordinary shares for shillings 30 each. The average market price was shillings 48 per share. So as at 1st March 2013, none of the employees had exercised their options. So that is why I have said that when I will be doing diluted earnings per share, because it was among the requirements here, when I will be doing diluted earnings per share, I said we have to use the potential securities, the one which are likely to be converted or unlikely to be converted to ordinary shares. So they bear the word convertible, including what? Share options and warrants. So which means that share options and warrants, they are specifically used in diluted earnings per share. And these options is just a privilege which is given to the employees to purchase shares at a certain price, which is lower than the market price again. That is fine. So which means that that share options is specifically used in diluted earnings per share. For note 4, we used it because I said we used, yes, it is convertible, of which convertible we use under diluted. But I used the portion of it, the 10, because the total security was 25. We used the 10 because the 10 was the one which was specifically converted to ordinary. But now when I will be moving to diluted, I will be using the total value 25. Even if I will record it separate, the 10 and 15, I will be dealing with the total value. So anyway, you will understand that when I will be moving to diluted. But for now, you have to know that for share options and the warrants, that is just specifically used for the purpose of diluted earnings per share, beside the convertible securities, or we call them potential, the one which are likely or unlikely to be converted to ordinary shares. So after we are done with the analysis, now you can apply in the formula, because ordinary shares before the right issue is what? 7.5. Ordinary shares before the right issue. So here we have 7.5.
Yes.
So this one could be 7.5. Then what about the fair value before the right issue? This one, the fair value before the right issue?
5.
The fair value was 5. It cannot be 5. So what you always do, you go to the statement where the right issue occurred. So note 3, they said on 31st August 2012, the company made a right issue of 1 ordinary share for every 4 ordinary shares held on that date. The exercise price was shillings 36 per share, and the come right price on the last quotation was 14. So this is the fair value. This 48.
Okay.
Which is higher than the exercise price of 36. You know the definition of right issue very well.
Yes.
Yes. Obviously, the market price will be higher than the exercise price. So sometimes they will say this way: the come right price on the last quotation, that is the market price. Then how do you get the theoretical exercise price? So you know that. You say 1 ordinary shares for every 4.
Every 4.
So which means that is 1 new words.
We have 7.5.
Hmm?
Hmm?
Theoretical exercise price. So 1 new at what price?
36.
1 new at 36. For all at 48. Eh?
Mm.
Yes, for all at 48. So because now the proportion was 1 new, they were given 1 new for every 4.
Yes.
So the 1 new they were given at the lower price of 36. And the one which were there for old, which were being held, which is the old, were going at 40, the market price. So you multiply 36, and this one is
192.
192. So this is 5, 36 plus,
228.
that is
228.
220. So you divide by 220 divided by 5.
45.6.
45.6.
0.6.
And that is how you get the theoretical. And that is how they arrived at this. Anyway, that is how they arrived at the theoretical. So then period before right issue,
Can you scroll the question up?
so period before right issue. So remember that our financial year was ending 31st March 2013, and it was starting 1st April 2012. The right issue occurred on 31st August. 31st August. So the right issue occurred on 31st August. So the period
5
before.
months.
So from April to the end of August.
5 months.
That is 5 months.
Yes.
So that is how you always determine the period before. So you have to determine when is the period our financial year is starting, that is, and when our financial year is ending. You have to draw that line so that when you will be determining the period before, you just input the period when the right issue took place, so that you check the period before and the period after. So that is how you make it easy. Draw that line, determine when the financial year is ending, when the financial year is starting. Right when the right issue took place. Count the period before, the period after. So,
Okay.
so for the earnings per share, these dates are very important. These dates are very important. So that is what we have already done. So for the ordinary shares after the right issue, so we are already done with the period before. Now we move to the ordinary shares after the right issue. So ordinary shares after the right issue, now you took your shares up to that period. So 6.5 plus 1.5 plus the one which were through the right issue. So you get the total 9 point something.
9.375.
Then period after 7 months, because the period before was 5.
5, yes.
Yes. So, but remember now, here in 2013, there is element of 0.25, which has not been applied in the formula, but it was there in that period. What can I do to that 0.25?
You determine it separately and then you add.
Yes, you just wait separate. So you wait for how many months? So from January to the end of the year, which is March, for 3 months.
For 3 months.
Yes. So that is why you can see they did this. So this is what I've been explaining. So here what they did separately before, because 7.5 times 5 over 12 times 48, you divide by 45.6. I think this is the first thing. Then they added with ordinary shares after the right issue times period after. They got 5. That is fine. Then they did this separately. The one I've said, the 0.25, because it was not affecting the formula, but it was there in that period, 2013. So you have to wait separately for 3 months, and from January when they converted the bond to ordinary. So from January 2013 to the end of the year, which is March. So that is okay.
Yes.
So since we are done with the one-offs, and already we have captured when there is this element of a right issue, that is what I was explaining. So we can be able to get the basic earnings per share. So which means that now basic earnings per share, you will take the 83.6. I think you remember we arrived at 83.6.
Yes.
Yes, 83.6 was here. We took the profit after tax, we subtracted the preference dividends. We got 83.6. So the other thing you can subtract here, if it's present, I said, is the profit attributable to non-controlling interest. Profit attributable to non-controlling interest, the minority interest. So that is the only thing you can subtract there. But there was none. So which means that our basic earnings per share is 9.48 per share. So that is 9.48 per share. So now what about diluted? Because that was the second requirement. So that was the second requirement, number 2. So we are done with the first one. So number 2 is now the diluted earnings per share. So for you to do the diluted earnings per share, I have to introduce a bit about the diluted earnings per share. So we say that basic earnings per share is said to be diluted. So basic earnings per share is said to be diluted if, so there's if convertible securities, not at, this is if convertible securities have been converted or are to be converted to ordinary shares. So you remember me speaking very well then, when I will be doing diluted earnings per share, we use which securities? Can you remember? We use which securities?
Can't remember.
The convertible. See, I've just said that. The convertible securities. I said we call them potential securities. The one which are convertible to ordinary shares or likely or unlikely to be converted. So it's not a must that they are convertible, yes. Yes, they will be pairing the word converted, but it's not a must that they tell you that they were converted. Yes, they will pair the word convertible, but you will find that they were never converted in real sense. So that's why I say that they are likely or unlikely to be converted. Yes, but they must bear the word convertible. So that's why you can see they are saying that basic earnings per share is said to be diluted if convertible securities have been converted or are to be converted into ordinary shares. So they are likely or unlikely to be converted to ordinary shares. So convertible securities are considered to be potential securities. Convertible securities are considered to be potential securities since they bear a conversion clause. So they bear the word conversion. That is what they mean. Therefore, diluted earnings per share is computed on the assumption that these securities will be converted into ordinary, with the assumption that they will be converted into ordinary shares. So I think you are getting me correct.
Yes.
So they are likely or unlikely. I think that is now I think that one is coming out now. When I say they are likely or unlikely to be converted to ordinary shares. But for the basic earnings per share, we use the securities which are converted. That is why when they talked about the bond, we dealt with only the 10 million, which was specifically converted.
Yes.
Because the total security was 25, but we dealt with the 10 because now that one was the one which was specifically converted. But now for diluted, I will be dealing with the total 25. Because now we will go with the assumption that this security will be converted, even if the 15 will never be converted.
Okay.
So steps, so determining the order of rank. So steps now of computing this. So these are about the steps to do the diluted earnings per share. Steps to compute. So steps we use to compute DPS. So we call it diluted earnings per share. So we start with determine the order of ranking the securities. So you determine the order of ranking the securities. That is, securities with the least effect on basic earnings per share should be ranked first. Then compute the diluted earnings per share based on the ranks. So you first rank. Next, you compute the diluted earnings per share based on the ranks you have done. Then the risk value of EPS is considered to be diluted. Sorry. So let us now do the diluted earnings per share. So on the same question, so for the diluted earnings per share, for you to do that, now for the computational part of it, in order now to do now the presentation of the diluted earnings per share, remember that we have just looked at the steps, or we have just taken the steps we are supposed to follow. So we know them. So we have to rank the securities, then we compute diluted earnings per share according to the ranks above. Then after that, we have to take the risk security. That is the one which has a risk effect to the earnings per share. So which I've said that, remember that we have potential securities which are supposed to be used. And that is the one we always use under diluted earnings per share, the potential securities. So we always use the potential securities, of which the potential securities, example of these potential securities, I've said an example of this is all about the convertible debenture. So I will be dealing with the convertible debenture. So we have the convertible preference shares, and I have the third one, share options or warrants. So we have the third one, which is all about the share options, or we call it warrants. Share options or warrants. So that is the three potential securities which I will be using. So, and I said that the main thing under diluted earnings per share is all about understanding we have to use the securities which are likely to be converted or unlikely to be converted. I think that one I explained well when I talked about the introduction part of this topic. To be specific, when I talked about the introduction part of diluted earnings per share. So that is why right now, when we issue a security like a convertible debenture, like now when a company makes that, let me use a good example of preference shares. When a company issues preference shares, which are likely to be converted or unconverted. So out of the preference shares, the entity will be paying dividends. So if now, yes, they will be paying dividends. So if they will convert this security to ordinary, because now they are being converted to ordinary. So if it's likely to be converted to ordinary or unlikely to be converted, yes, if they convert or unlikely to be converted, remember that the entity will never pay that dividend. So which means that there will be a saving out of that. So that is why when I will be drawing my table here, I have to start with potential securities. Potential securities. After the potential securities, I have to talk about incremental earnings. Incremental earnings. Then we have incremental shares. Incremental shares. Then after the incremental shares, we have to talk about the earnings per incremental shares. Earnings per incremental. Earnings per incremental shares. Then finally, the last column is all about you do the ranking. You rank. That is the last thing you do. So this one implies that why am I having this first column, incremental earnings? Because I've said that now the preference share, the convertible one. Remember, there was out of the preference share, they were supposed to pay dividends. So if they will convert that security to ordinary, remember that dividend will never be paid. So the entity will make a saving. So that's why there will be an incremental earnings. So since they have converted to ordinary, that is why we will have the second column, incremental shares. So there will be an increment in terms of the ordinary shares. Then you determine earnings by incremental shares by dividing the earnings, as incremental earnings by the incremental shares. Then you rank once you are done with all of the securities. And that is what I did here. That is what I did in this question. So you can see I talked about potential securities, incremental earnings, incremental shares, incremental, that is earnings per incremental shares, then you rank. So for the first thing, in this question, there were around 3 or 2, there were 2 potential securities. So the potential securities were in this question, include, we have this bond, the bond which was there, this one, the convertible bond, and we have the share options. Because I've given you the examples. So out of the examples I've given you out, we have 2 of them. And we have these share options. So that is only 2 potential securities we have to deal with. Then again, another thing, even before we continue, is all about when there is a security of which the entity needs to pay interest in return, and remember that it will not pay interest on that, you have to apply under the earnings on that security, you have to apply something called tax shield, which is 1 minus T. So 1 minus T, T is tax. That's why the examiner gave you the 30%. This 30%, the corporation tax rate of 30%. So for the first thing you do, let's start with the bond, the 25. But remember, out of the 25, 10 was converted. So 15 was unconverted. But remember, under diluted, you deal with both, likely or unlikely to be converted. That is why first I started with the one which is converted. So you can see I started with the one which is converted. So convertible bond, incremental earnings. For the incremental earnings, we take the 12%, because now you have to apply the contractual rate. It was a 12% bond times the 10, which was converted. First, you deal with the converted. 10 was converted. I think you remember that. For the period up to the conversion date, when did the period of conversion took place? When did they convert that 10? So this one was converted on, so this, January 2013. And remember, our financial year starts April. It was starting April. If I'm not wrong. Our financial year starts April or when? Yes, it starts on 1st April 20. Our financial year starts on April 2014. So if the year starts 1st April 2014, so that is what I mean, that from 1st April 20. So because that is when the financial was starting, from 1st April. So from 1st April to January. So that is 9 months. So that is why I was taking 12%. You multiply with the security first, the one which was converted, the security which was converted, the 10, I think the 10, you know where it's coming from. Then you multiply with 9. You multiply with 9 up to the date of conversion. That is what we have done here. Then you have to multiply with this 0.7 because now this security is all about a bond. The return which was the company was supposed to pay is interest. And remember, they have converted. So the return, where we have a return of interest, and the company never paid this because already they have converted the bond to ordinary. So there was a tax saving, because out of the interest, they never paid the interest.
Yes.
So that is why I'm applying the tax shield, 1 minus T, 1 minus tax, the 0.7. So 1 minus 0.3, 1 minus T, 0.7. So this one is applicable whereby the benefit which the company which was supposed to pay to the relevant holders of that security was interest, but it never paid that because they converted. So where we have interest is where you apply this and earnings, the 0.7, the tax shield. Then again, we deal with the incremental shares before we move to the unconverted. Remember, the first thing I'm dealing with the one which was converted. So you remember how they converted that security in the proportion, 10, for every 10,000 of the bond, they converted to 250 ordinary. What about the 10 million? So up to the date of conversion, this is what I'm speaking of. This one, the one which was converted, each 10,000 of the bond is convertible into 250 ordinary shares. See, they converted 10 million.
Yes.
Out of the 25. So we have dealt with that. So up to the date of conversion, that is from April to January 1st, 9 months. So that is what we have done. So again, we have to deal with the same security, which is the part which is unconverted. Because I said for diluted earnings per share, you deal with both security, which is likely to be converted or unlikely to be converted. So that is why you can see for the unconverted, it was 15. So the only thing you change there is 15.
Yes.
So period is just 12 out of 12. That is why you can see I'm not multiplying with a period.
Yes.
Because obviously that security of 25 was there for the entire period. So it's only that the one which was converted, we deal with that up to the date of conversion, up to January. But the remaining 15 was there from the start to the end of the period.
Yes.
Yes. That is what I could have done here. Anyway, for more understanding, I could have just, so I could have said this. So these are about 12 out of 12. That is what, it's 1. So that's why I never did that. Then you apply 0.7. I have explained why you do that by application of 0.7. Then again, incremental earnings, remember that it's only that you change this 10 to 15. The one which is unconverted again. And you know that the period there is again 12 out of 12.
Yes.
Because the 12 was there for the entire period.
Yeah.
All right, that is fine. So that is how you get the 1.26 and 0.375. So you have to add this and this to get the earnings
Okay.
for the converted and unconverted. So that is fine. The same with
Yeah,
incremental shares, that and that one. So to get the total, so you get 1.89 and 0.5625. So that in order to get now the incremental earnings, that is earnings per incremental shares, to get the earnings per incremental shares, you divide the earnings, incremental earnings with the incremental shares. So any question up to that point? So for the last security, that is the share options. We always for the earnings it will always be zero, because now they say that no employee exercised to that option. No employee exercised to that option. That is why you can see the earnings there is zero for the relevant share options. Then for the incremental earnings, this is what you do. So the bonus element, because now they were given an option, to purchase the shares. So because that is not 5, they were given an option to purchase the 1 million ordinary shares at 30 shillings 30. The average market price was 48. So they could have made a benefit of 18. So you take the 18, you divide with the 48 times 1 million. Then you multiply the months you weigh from January to the end of the year. That is 3 months. So 3 out of 12. So that is how you arrive at this element of 0 point something, 0.00 something, 0.009375. So 48 minus the 30. So 48 was market price minus the 30, the exercise price. You divide with the 48, then multiply by 1 million, the shares which they were given to purchase at a lower price of 30, other than 48. You weigh for the 3 months from January to the end of the year. Then you divide 0 divided by 0.09375. You get 0. That is the third column. You get this 0. So then you rank from the list. That is what we said. So compute the diluted earnings per share based on on step 1 above. Before that, I said that determine the order of rankings. The securities, that is securities with the risk effect on basic earnings per share, should be ranked first for diluted earnings per share computation. For the diluted earnings per share computation. So which means that so now you rank from the risk. So the risk between 3.36 and the one we got 0, the one for 0 is the one which is the risk. So which means that is why the options will be number 1, then the bond will be number 2. Then you compute now step 2. You compute the diluted earnings per share based on the ranks above. But now you start from the basic earnings per share. Basic, I think you remember this. Earnings is the pause, shares is the one-nose. So that is how we got 9.48. Then you took the number 1. Number 1 is options, the one way we have ranked. So the column of earnings, I think you remember we got 0. For the column of incremental shares, we got this 0.09375. So you add 83.6 plus 0, that is 83.6, 8.8205 plus 0.09375. You get 8.91625. Then you divide 83.6 divided by 8.9625. So you get 9.38. Then finally, now you deal with the convertible bonds. So the convertible bonds, I think you remember we got the earnings of 1.89 and the shares of 0.5625. So again, you add and you get the totals there, then you divide the two. So that you get 9.02. Then now, in order to get the diluted earnings per share, you pick the least out of the three. The least is 0. That is not 0, but 9.02. The least out of the three. Any question? Because we are done with that question. That is why you can see, therefore, diluted earnings per share is 9.02 per share. So you take the lowest. Any query?
No, not yet.
Not yet. So that is fine. So some important notes to know is all about after share split or reverse split has taken place, any subsequent use of shares. So anyway, that one will be captured later when I will be doing another question. So for our next question, I will do now I will do specifically on the whiteboard. But I think even this one you have understood. But for more understanding, I will be doing on the whiteboard.
Okay.
So you could have a look at this question, try to understand it, so
Yes.
that we continue from there in our next session.
Okay.
Have a nice day. So for the online guys, for the YouTube guys, for the Facebook guys, LinkedIn guys, remember that never forget to subscribe to my channel after you have benefited from watching, taking the knowledge. Just give me a subscription and remember to click on the notification button so that you will be notified when there's another video which is upcoming. So have a nice day. We meet next time for another session of the same earnings per share.